Welcome to the Deep Dive. We're here to cut through the noise of earnings calls and give you the insights that matter. Today, we're diving into HP Inc.'s Q3 fiscal year 2025 earnings call. That was held after hours on August 27th. This isn't just a summary. We want to get to the real story, figure out what's driving things, and what it means for HP going forward. And I think the big question we're trying to unpack is this. Is the AI PC boom enough to offset the print struggles and, finally shake off that market skepticism?
That's exactly it, because HPQ, it's had a rough go. The stock's down, about 25% over the past year? And that really accelerated after Q2, remember. They missed cut guidance. Tariffs were a big part of that story. So leading into this call, they were already deeply focused on that $2 billion savings plan and, importantly, moving manufacturing out of China, trying to get ahead of those trade issues.
So given all that, you might have braced for more bad news, but this is where it gets interesting. Looking at the Q3 snapshot, HP actually posted its fifth straight quarter of revenue growth.
Fifth? Yeah. Quite a streak building there.
Revenue hit $13.93 billion. That beat the consensus estimate by about $110 million.
Yeah.
Pretty comfortably. And earnings. GAAP EPS looks strong at $0.80. That's up 23% year over year, and it beat their own outlook.
Non-GAAP was $0.75, right in line with what analysts expected.
Exactly. So on paper, these numbers look, solid, really solid. But the market reaction was kind of perplexing. The stock actually slipped maybe 1.9% after hours. What gives? What's the market seeing that isn't obvious in those headline numbers?
That's the core of it, isn't it? The market reaction often hints at underlying currents, and when you peel it back, it was definitely a mixed picture. Personal systems, that's the PC side, was the clear winner. Revenue up 6% year over year, hitting $9.9 billion. Units were up 5% too.
Okay, strong there. But printing?
Printing was the drag. Revenue down 4% to $4.0 billion, so you see that contrast. But importantly, despite that mix, cash flow was impressive. $1.5 billion in free cash flow, $1.7 billion cash from operations.
And they kept returning cash to shareholders.
Yep. Over $400 million back through dividends and buybacks. So that operational discipline, it's still very much there.
Okay, so personal systems is clearly the engine right now. Let's dig into that a bit more. What exactly drove that strength?
Management pointed to two things mainly. AI PCs picking up steam and the Windows 11 refresh.
Right.
They said AI PC adoption actually beat their own expectations. It's now over 25% of their mix. That's a whole quarter ahead of plan.
A quarter ahead, that's significant.
And double-digit sequential growth there, too. Sounds incredibly bullish. But, how real is this AI PC impact? Is it genuine tech or maybe a bit of hype?
It's a fair question, and I think the call gave some good context there. HP sees a real price uplift, somewhere between 5 and 10% for an AI PC versus a standard one.
Okay, so there's a tangible benefit.
Absolutely. And the ecosystem is building out fast. You've got software vendors, ISVs like Adobe, like Zoom.
Right.
They're actually shifting workloads to run locally, taking advantage of these new NPUs, the neural processing units.
Right, the chips inside. Exactly. Even security firms like CrowdStrike are using NPUs for things like faster memory scanning. It improves performance right on the device. And then there's the big one. Windows 10 end of support coming in October 2025.
The deadline effect.
Huge deadline effect. Over half the installed base still needs to move to Windows 11. It forces a hardware refresh for many. So yeah, AI PC might sound buzzy, but the tech is enabling real stuff. And it's tied to this massive, unavoidable upgrade cycle.
That paints a pretty compelling picture for the PC side. But then there's the flip side, printing. Down 4% revenue year over year. What are the headwinds there, and what's HP doing about it?
Yeah, printing definitely faces challenges. Management was candid about softer office demand.
Where specifically?
Particularly in North America and parts of Europe. And they also mentioned a, quote, rather aggressive pricing environment. So competition is fierce.
So tough conditions. How did they manage margins then?
That's the key insight, I think. Despite the revenue dip, the operating margin in print held up really well, 17.3%, right in their target range. Well, it wasn't luck. It was deliberate strategy, pricing actions, cost cuts, but also shifting the mix. They're focusing on more profitable, big tank printers for consumers, growing subscription services, trying to grab share in higher value office segments, and pushing industrial graphics.
So less focus on just selling boxes, more on profitable units and services.
Exactly. Hardware sales might be soft, but they said the core metric, pages printed, is basically on track with their plans. So it's about managing a mature business for profit, not necessarily for top-line growth like PCs.
Okay, let's switch gears slightly. Tariffs and supply chain were huge worries earlier this year. How are they doing on that front? Any progress?
Actually, yeah, quite significant progress. This was a big positive takeaway. They reported that almost all PCs heading to North America are now built outside of China.
Wow, nearly all. Where?
They're using facilities in Southeast Asia, Mexico, even some manufacturing back in the U.S. And these moves, this diversification, it directly helped offset most of the tariff costs they faced in Q3.
So real tangible benefit from that shift.
Absolutely. It shows real agility and significantly cuts down that policy risk that was hanging over them. A quiet win, but an important one.
And beyond the big numbers, they also touched on innovation, sustainability,
Right.
This whole future of work idea they push. Anything stand out?
Yeah, a few things. On the product side, their OmniBook 5 AI laptop won a Best of Computex award. The EliteBook Ultra was called out as a top AI PC. They also launched something called HP Dimension with Google BIM. That's for 3D video communication. Interesting stuff.
And in print, still innovating there.
Yep. Launched HP Neo, an AI chatbot for industrial print customers, and HP Build Workspace, which is an AI tool for architects and engineers. And they kept hitting the sustainability notes, too. 99% of products using recycled content, 100% renewable electricity in their U.S. ops. It's part of the overall package.
Okay, so let's tie this all together. Strong PCs, driven by AI, a print business being managed for profit, supply chain de-risk. Management sounded, I'd say, cautiously bullish on the call, right? Highlighting the beats, the AI momentum.
Definitely cautiously bullish, yes.
Yet, we circle back to that muted market reaction. Why the disconnect? Why wasn't the market more enthusiastic?
Yeah, that's the puzzle. I think it boils down to a few things the market is focusing on, maybe more short term. First, gross margins took a hit because of the mix shift. PCs, even with the AI uplift, generally have lower margins than printing supplies.
Right, more PC revenue means lower overall margin percentage.
Exactly. Then there's just the ongoing softness in print. It's still a big profit chunk, so any weakness there gets noticed. And maybe there's still some lingering nervousness about tariffs, even though HP seems to have managed it well this quarter.
So the narrative is shifting.
I think so. It feels like it's moving away from just managing tariff pain towards this story of an AI PC recovery funded by disciplined cash returns. But the market maybe isn't fully buying into the duration or strength of that AI tailwind yet. Still focused on those immediate margin pressures and the long-term print decline.
That makes sense. So looking ahead, what do they guide for Q4? And what's the longer view, especially with the holidays coming up?
Okay, for Q4, they're guiding non-GAAP EPS between $0.87 and 97 cents. So a potentially strong end to the year. And crucially, they reiterated their full-year free cash flow guidance, still expecting $2.6 to $3 billion. That's a lot of cash.
And the segments.
Personal systems revenue is expected to follow normal seasonality, think holiday uptick, driven by that continued AI PC and Windows 11 momentum. Margins there should stay in that solid 5-7% range. Print revenue also expected to follow seasonality, but margins could be near the top of their 16-19% range. Why? Better supplies mix during the holidays.
Got it. And capital returns.
They doubled down on the commitment, return roughly 100% of free cash flow over time, especially as their debt ratio improves below 2 times leverage. They basically signaled more buybacks are coming soon, definitely playing the long game there.
All right, now for our favorite part, the not financial advice segment. We're going to throw out some wild, maybe plausible trade ideas inspired by this call. Keywords, illustrative, not advice. Do your own homework.
Okay, first idea. The AI PC adoption acceleration bull call spread on HTQ itself. The thinking here is, look, management sounds confident, adoption is ahead of schedule, you've got Windows 10 EOL in the holidays. Maybe the market is underestimating how strong this tailwind could be into next year.
So how would that work mechanically?
Well, you could buy a call option, maybe strike $27.50, expiring sometime late next year, maybe early 2026. And to finance that partly and cap your risk, you'd simultaneously sell a higher strike call, say $32.50. Basically, you're betting on moderate upside, driven by that AI PC story finally getting fully priced in while defining your risk.
Okay, interesting. Betting on the core story. What's the second idea? A bit more contrarian.
A little bit, yeah. Let's call this one the print protection play, put right on a competitor.
Okay, so not on HP directly.
Right. The rationale is this. HP is managing its print business tightly for profit, even with headwinds. They seem relatively resilient because of their scale, their subs, their cost discipline. But that aggressive pricing environment they mentioned, it probably hurts pure play printing companies' ones without a big PC business even more.
So you're using HP's insight about the industry.
Exactly. Find a competitor who seems more exposed to those pressures. Then you could sell an out-of-the-money put option on that competitor. You collect premium income up front. If the competitor holds up okay, you just keep the premium. If they struggle and the stock falls below your strike, well, you might end up buying shares at what could be a discounted price, potentially betting on long-term consolidation or recovery in the sector. It's an indirect play on the print market dynamics HP highlighted.
Fascinating ideas there. So, to wrap things up, HP's Q3 showed real strength in personal systems, fueled by AI PCs hitting faster than expected. Cash flow was solid, and they've done a great job managing the tariff situation.
Yeah, print is still a challenge, but they're strategically focused on protecting profit there, not just chasing revenue.
The immediate market reaction was hesitant, but the strategic moves, especially de-risking the supply chain and going all in on AI PCs, suggests HP is really focused on the longer term.
Which leads to the provocative thought for you, the listener. Is the market currently undervaluing those multi-year tailwinds from the Windows refresh and the whole AI PC ecosystem build-out? Is it too caught up in the short-term margin story and the known decline in print? Are investors potentially missing that bigger picture shift?
Something to definitely mull over. And just one final reminder. Everything discussed today, especially those trade ideas, is purely for informational purposes. It is absolutely not financial advice. Please, always do your own research. Thanks for joining us for this deep dive into HP's Q3 earnings.